Someone doesn't know what the date is today. I tend to remind myself every day because I'm just like, where am I? Who am I? And what's the next thing in life, right?
Well, we know, Pumla, the view one salaries came in and out. It's gone.
You know what? At least you get a salary. If I could, like, I don't know if anyone has a side hustle or has been in business before, but I mean, there's positives and negatives to everything, right? It's like absolutely everything in life. And I started off in hospital setting, and then I was in corporate, like most of you guys are. So I was getting a set salary every month, and knew exactly how much I was going to get, could plan around it, all the things. And then 11 years ago, almost to date, my husband passed away suddenly. So it was the 26th of March. So tomorrow is actually like the anniversary for that. And then, in all my wisdom, I decided to leave corporate. I mean, I stayed for a year because if anyone has been through any sort of grief counseling, they always tell you to stay and do the same thing for a period of 12 months at least, just to stabilize and not make silly decisions. So I stayed in corporate for 12 months. And then after 12 months, I left and I started my own practice. And I left mainly because my kids were like 5 and 3 at the time, my boys. So I just felt like I needed a bit more like hands-on time with them. So it was a good parenting decision, but it did mean that I went from double income household to now a single income household to then a single income household in a business setting.
Sure.
And so then the salary does this the whole time. And I remember the first year after I did it. I mean, my whole family thought I was crazy and that I shouldn't do it, right? But I did it anyway. And I went home. So I'm originally from Eswatini. So I drove home in December. My dad is an accountant and he has a firm. And I said to him, I'll do anything. Like, I will be your receptionist. I will clean the floors, just employ me. And then I'll be fine. And obviously, in his wisdom, as any father would, he was like, no, you made this decision. So you need to go back and you need to sort it out and figure it out. So then, so a year after I started, so I left Alex Forbes, so I left my cushy, like, set salary every month. And then we came back to Johannesburg and I was just like, something has to work out, right? So then I went and I approached a set of associates where I worked because I worked at Netcare Rehabilitation Hospital. So it's a full hospital with neuro and spinal, and I'll get someone to come speak to you guys from there. And then I started my own practice. And now it's been 10 years, guys, of running my practice myself. And the first year, if anyone again has run a business, you double your income very easily because your base is small, right? Like I probably went from earning, let's say I earned a third of what I used to earn. So let's say I don't even remember how much I was earning. Let's say I was earning 20,000 Rand. So then I started in my private practice and then I was earning maybe like 5,000 Rand. But then after 12 months, then I doubled that, right? So then let's say I was earning 10,000 Rand, but it's still half of what I was earning when I was in corporate. And then COVID happened, and we all know what happened during COVID. So then again, the salary goes down. And then you slowly, slowly, slowly pick up. But in the last 3 years, my business has had a 20% increase in revenue, which has been great, especially with the economic times. But it's also taught me how, as a professional, right? Because we're all professionals here. As a professional, you can know your trade, but knowing your trade alone doesn't guarantee that you will get the clients to make the income that you require. Um, and so like even if you have a side hustle, you know that there's a lot of customer processing, there's a lot of pitching, there's a lot of marketing, there's a lot of other nuances that come into a business. So if you are fully employed, I always say, stay where you are because you know that you got something set. And then if you want to do something, do it on the side, build it up, and then only leave. Don't do like what I did. I literally did a free flow. I just left. And it was hard at the beginning. And it's only now, like 10 years later, that I've been able to kind of build my way up. Um, but then some people say that if you don't do that as well, then you'll never create a business or you'll never leave corporate, you know? And I'm not advocating for anyone to leave their jobs, just saying. I'm just sharing my story and my reality as it comes to, the anniversary of me basically changing my life completely, or my life changing for me completely. So yes. Before Joe wonders what on earth we're talking about. Joe, I'm not saying anyone must leave their jobs. I was just sharing my journey into running my business.
That
Back in
sounds like you were giving a lot of nuggets of wisdom. I'm sorry I missed the first part. Sounds great.
Yeah, it's just 10 years. I've been running my practice now for 10 years. So I was just sharing the journey of starting my own practice, being my own boss, and all the positives and negatives that come with it. Because people got salaries, and I'm just like, wow, that is so amazing. Imagine getting a salary. It's like that steady income is also something to value. It really is. So if I can just maybe kick off with what's going to happen today, guys. Um, are you both coming on, Joe? Is it just you today? Is Lizanne coming?
It's just me, Pumla.
Okay, no problem. So Joe's gonna take us through the FSCA so that you get an overview. So basically almost like taking a step back. The last couple of weeks we've been doing more like product involvement, and like looking really at the products and what they look like, what the nuances are, how you develop them, how you distribute them. And so all of that sits within an umbrella of of a framework, of a legal framework. So we're going to do that legal framework this morning. Joe, you're gonna take I think you have until 12-ish. I don't know if you need all the time, but we'll see how it goes. And then I will take over from there from where Joe leaves us. And then after he finishes, then I'll take you through what the afternoon is going to look like. Okay, if you have any problems, just WhatsApp me, Joe or Pam. I won't be fully in the session. I need to prepare for the afternoon for the delegates.
Perfect. Thank you very much. So Pumla, are you happy for me to start, or should we wait until?
No, I think no, let's wait until 9. I actually didn't see the time there. Let's wait
Okay.
until that, yeah. So you can try maybe share your slides, and then you can see if that's gonna work.
Perfect. So I'll try not maybe to use the full 3 hours. It's a lot of information to take in. Just speaking about the legal framework. So I'll see where we need to focus a little bit more in depth, and where we can maybe just stick with overview and the principles. But let's see how far we go then from 9 o'clock. But I'll try to share my slides quickly. You can just let me know if you when you can see them.
Okay, sure. Pam, if you could just send me a WhatsApp when Joe's finished, so that I can just log back on.
Okay.
Thanks. Just see if everyone's here. Let's just count. 1, 2, 3, 4, 5, 6, 7, 8, 9. Guys, if you don't have your cameras on, please just give us a thumbs up so that we know that you're here. And just another reminder that next week you have your first MCQ. Let me just check the date. Yes, next week, Wednesday is the first. So the first Wednesday of every month, you have your MCQ. So you need to make sure that your cameras are working on that day. And so you will just get the MCQ questions and probably some short questions associated with that. But in the afternoon, I'll let you know because I'm probably gonna sit down and put that together for you guys.
It seems I can't share on my side. When I press the share button, it doesn't allow me to share my screen.
Okay, let me see if I can fix that. Sorry, guys, please just give me a moment to try to fix this. Joe, just please try again. I went on and I checked. We have everyone is being able to present.
Let me quickly exit and try to enter the meeting. Maybe that will fix it. Just give me a second.
Okay. Sorry, guys. So, how is everyone? Who's got a business? Someone's got a business here. Tell me. I'm always interested. Who's got a side business? Go and tell your bosses. Who's got a side business? Nobody. No, I don't believe you guys. There's always someone who does baking or does like something.
I do, but it does not generate any income. Instead, it's expenses.
Then it's not a
Mothering.
business, ma. It's a hobby. It's an expensive hobby.
No, it's not a hobby being a mother.
Ah,
It's a full-time job.
I know that doesn't count. That one you chose. That one is just
No,
a
I
natural
never
thing.
chose it. They just gave me a strange auntie from hospital. I don't know why.
Hey, these mothers, you guys hear what these mothers are saying about their children? Sure, that's interesting. We always have people who do things on the side. Anyone want to start something on the side? No? Wow, guys, I feel like you're just being shy. I I don't believe you. I'll ask again. Oh, yay. I think Joe is managing.
Yes, I don't know if you saw my screen for a moment.
Yes.
Okay, perfect. So I'm just gonna share it again and then we can kick off.
Aren't we supposed to say Dr. Joe?
It's not necessary.
Joe has a PhD that he clearly doesn't want anyone to know about.
No, I think it was only for like the first week after graduating that I felt, look, at least there needs to be some kind of change just for all the hard work. But now not anymore. But thank you, Pumla. So just good morning, everyone. I'm Johan van der Lith. Everybody calls me Joe that knows me, so please feel free to do so. I'm a senior specialist in the regulatory framework department at the Financial Sector Conduct Authority. My work focuses on assisting to draft and develop legislation for the FSCA. So I work a lot on the insurance side and then also on financial technology with a focus on crypto assets, open finance, artificial intelligence, and so forth. So it's great to be here again. Thank you, Pumla, for inviting myself and Dazan. We usually present together. Unfortunately, she cannot be here today as she has another commitment that she can't step away from. So it's great to see you all. I thought maybe before we delve into the legal framework on the insurance side, maybe if you can just tell me quickly, just shortly, your name, where you're from, and maybe something interesting or challenging from your work. That would be fantastic. So that would be great if we can start with that just shortly, and then we'll go into the rest of the presentation this morning.
Maybe if you can put your camera on as you guys introduce yourselves as well, just so Joe can see you and then you can
Absolutely.
pop it back off.
Hi, Joe. I'm
Hello.
Pam. I'm from AIG. Yeah, I'm Pam. I'm from AIG, and my challenge is what you're going to address today: the legal framework, the FCA.
Excellent. We'll sort it out for you today.
Okay, thank you.
Hi, Joe. I'm Arlene. I'm a legal advisor. And currently, well, I don't think I'm going to answer what you want to hear, but yeah, so I've seen this, but I haven't looked at it in quite some time. So I'm looking forward to looking and learning again what this is about. I looked at this or dealt with this when I did my postgrad in financial planning.
Okay, perfect. So let's refresh you to this morning.
Yes.
Hi, Joe. My name is Mangele. I work for
Oh,
AIG. I'm a claims assessor. I'm just excited to learn the legal side in this industry.
perfect.
Hi, Joe. My name is Sokopoto. Senior Claims Assessor Team Leader in the RMA. I'm glad to hear today, trust me, because I'm battling with my RE1.
Ah, yes, it's a big challenge.
Yes. Maybe I'll get some tips today.
I
I
hope
have to
so. I
be
hope so.
an attentive listener. Thanks.
Great.
Hi, Joe. My name's Keisha. I'm from Holland. I assess funeral claims.
Oh,
Yeah.
perfect. Nice to have you here.
Morning. I'm Monia. I work by PPS Insurance, Namibia. I
Oh,
work as an
Namibia,
underwriter.
fantastic. Okay,
Yeah.
that's
So
wonderful.
every day is a challenge in the underwriting space. There's nothing that's not challenging.
Absolutely nice and complex area.
Yeah.
Morning, Joe.
Morning.
My name is Nzwaki. I am a junior specialist at APSA. My challenging thing about my work, I think it's the legal side of things. But when I saw your presentation, your twig pick, I got so excited because
Oh,
that's
wow.
where my interest is. Yeah, I'm looking forward to the session. Thank you.
Oh, fantastic. I'm glad you're looking forward to it. And yes, it's always a challenge when it comes to legislation and interpretation thereof. So I hope I can be helpful today.
Good morning. I'm Sonia from PPS Insurance Namibia. I think the most challenging thing about my job is when you decline a claim based on the policy rules, and then you get this member that comes for you. But all you
Absolutely.
did was you just made the decision based on the rule. It's like you, as if you have written the policy rules. So yeah.
No, definitely nice to have you here. No, absolutely. I think for a lot of policyholders, obviously on the life side, it's an emotional time when there's a claim. So it's very difficult sometimes to deal with those policyholders at that moment, even though there may be a legitimate reason for declining the claim. But nice to have you.
Thanks.
Morning, Joe. My name is Snodhile. I work at RMA. I work in the group risk space as an assessor. Piggybacking off what Sonia said, it is difficult trying to explain the rules and the policy wording. And yeah, I guess it also fits in with the legalities of the policy. Yeah.
Absolutely nice to have you here this morning. I see we have a bit of a contingent from RMA and from PPS and Namibia. That's awesome.
Hi, Joe.
Hi, Joe.
My name is Lafuna from My Way Life. I am a life cover claims assessor. And the challenging thing with my job is having to apply TCF when you are declining a claim. So I find that very challenging. And once you apply TCF, there comes another claim again. And you also have to refer to the previous case. Yeah.
Absolutely. No, it's not easy, principle based. I think it's fantastic to work on a principle base, but it can sometimes be challenging when it comes to difficult scenarios. So understandable. Nice to have you here.
Hi, Joe. I'm Pam. I'm also from RMA, a medical claims assessor with Snotile. And she and Sonia
I relate to what they're saying. Also just really interested in today's session. I think when I saw that FSCA thing, all I could hear was those adverts on TV that end with the disclaimer of this is a registered FSP. And I'm always like, what does that even mean? Like,
Wow.
you know, so yeah, I'm quite interested.
Let me enlighten you today on that. Great to have you here, and it's interesting to have the medical claim side here as well this morning.
Hi, Joe. My name is Man. My challenge is when I have to access that cover, and I'm also looking for.
We lost you there for a second, the sound.
Oh, sorry.
There we go, much better, much better.
Okay. Yes, my name is Manti. I'm from Holland, and my challenge is when I have to assess a life cover claim that is still within the pre-existing condition waiting period. And I'm also looking forward to today's session.
Nice to meet you. Glad to have you here. Fantastic.
Okay.
Is that everyone? There's somebody else still? Okay. Think that's everyone. So fantastic to have you here. Please feel free to ask questions as we go along. I'll try to give an overview on some of the areas like a Twin Peak model and the current regulatory framework covering both the prudential and the conduct side. We'll stop a bit at the claims management rule because obviously, you know, that's very important specifically to your work. And we'll end off just with some practical case studies. Let me get a feel of your thinking about TCF and how to apply that. It's always interesting for me to hear the different views and approaches when it comes to practical case studies. So I hope you enjoy the session. I know it's going to be a lot of information and information heavy, but it's important just to understand, have a good grasp of where it all started and really the nitty-gritty of the legislation. So we're starting off with the Twin Peaks model where we are at the moment with the Financial Sector Conduct Authority and the Prudential Authority. So the Twin Peaks model or approach is really a form of regulation by objective. And it's one where there's a separation of regulatory function. So there isn't a combined regulator that deals with both the prudential side and the conduct of business side, but you have specific focus regulators, one that focuses on the safety and soundness, and the other one that really looks at the customer side of things on the conduct of business side. So under the Twin Peaks model, the financial services industry and the structures thereunder, it has these two regulators, as I just mentioned, and the market conduct regulator, the FSCA, that was established from a restructured financial services board. So for those of you that have been in the industry for quite some time, you'll remember the old FSB before that was restructured into the Financial Sector Conduct Authority. So the Twin Peak model, where it started, it was operationally pioneered by Australia. That was way back in 1998. Since then, there's been various regulators that have adopted this model. Some of the examples are the Netherlands, Belgium, also New Zealand, the UK, and obviously South Africa as well. So what triggered South Africa to take on a Twin Peaks model? I mean, it's a major restructuring of the regulators. We had to not just from a structural perspective, have these two regulators and their reporting structures and their employees and everybody from that perspective created, but also from a legislative perspective. And I'll explain to you what we needed to change in the legislation to create these two regulators. So some of the things you'll see on the screen there was fiduciary fraud against 47,000 widows and orphans that was exposed in 2007. And it really showed that there was a severe weakness in trust and governance and financial oversight. There was also the global financial crisis, just to name a few, and also some international assessments like the IMF, it's the International Monetary Fund, FSAP, that happens every 5 years, and the G20 Financial Stability Board peer reviews. And all of that showed that there were certain weaknesses that need to be addressed, and there needed to be a stronger focus on the market conduct side and a dedicated focus on the financial stability side as well. So the new approach really prescribes a shift from a fragmented regulatory approach to a much more extensive approach. And this wasn't done willy-nilly. It's really a very structured approach. So there was extensive research that was conducted, and there was substantial consultation with the industry and with various stakeholders over a period, I think it was about 8 years, before we reached this point where there was the structural change to the two regulators. So you'll see the Financial Sector Regulation Act. That is the act that creates the two regulators. So if you have an opportunity and you have interest, you can have a look at those sections that sets out the establishment within the Financial Sector Regulation Act, and then also sets out what are the functions and objectives of these two regulators. And after that, it sets out the powers of the regulators. So the objective, as I said, that was to split the regulating authorities of the financial sector into the two entities. So the first entity that was created by the Financial Sector Regulation Act is the Prudential Authority, which falls within the Reserve Bank of South Africa, and it supervises the safety and soundness of financial institutions. So this entity is headed by the governor of the Reserve Bank and is overseen by a committee, which also includes the governor. So the second, where I'm from, is the Financial Sector Conduct Authority, and that replaces, as I've mentioned, the Financial Services Board, and it supervises the manner in which financial institutions conduct their business and also treat their customers. So that's our focus. So the FSCA is a standalone institution, not like the Prudential Authority that sits within the Reserve Bank. And we are managed by an executive committee. And you might be aware that executive committee consists of our deputy commissioners and then also, of course, our commissioner, Kamlana. And you also have governance committees, for instance, remuneration, audit, and risk committees as well. So on the slide, you'll see the objectives of the two financial regulators. So you'll see on the left-hand side, there's the FSCA. We're really there to look at the efficiency and integrity of the financial markets, and the big focus is promoting fair treatment of financial customers by financial institutions. We also assist, although it's not a direct objective, but we also assist with maintaining financial stability with the Prudential Authority. So on the Prudential Authority side, it's about safety and soundness. They focus on financial institutions that provide financial products and security services. So you'll see where the difference is in objectives as well. One of the differences is that the FSCA also looks at financial services, not just the products, whereas the Prudential Authority focuses on products and services only when it relates to security type of products. So on the enforcement side, we have the Financial Services Tribunal. So that provides enhanced transparency and accountability. And the tribunal has the power to hear and decide on appeals and reviews of decisions made by these regulators. Okay, so that's just a brief overview of the Twin Peaks model. As you can see, it was a major shift in South Africa, and I think the industry also definitely felt that shift where there was a dedicated focus on market conduct. With a lot of focus on market conduct, from my experience, I really saw a shift from just an awareness or a secondary focus on customers in some institutions to really embedding treating customers fairly within the institution, and not just at a certain level, but really from senior management down to your client-facing employees as well. So for those of you that have been long in the industry, you may also have been part of this shift and saw that within your institution as well. So this is an extremely busy slide, as you'll see, but it just sets out the existing regulatory architecture. So you can see there's a lot going on. You have your Collective Investment Schemes Act, Short-Term Insurance, Long-Term Insurance Act, Pension Fund, Financial Markets Act, Banks Act. This is a very complex architecture for anyone in financial services to understand and be sure where those requirements that fit towards their institution apply. So there's a lot of different pieces of legislation that are currently in place. But this is being changed, and that's what I want to speak to you about on these slides. So the end goal of Twin Peaks is really, from a market conduct perspective, is to replace all these different sectorial laws that I just shown to you governing conduct of business. And we want to make sure that it goes into one big overarching piece of legislation. So I'm sure you've all heard about the COFI bill. That's a Conduct of Financial Institutions bill, and will be the Financial Institutions Act once it has been enacted through Parliament. So we're all anticipating this big shift from a conduct perspective, where you have all this one overarching act, and it repeals all these different sectorial laws when it's enacted. So waiting for that bill to go through the parliamentary process. It may be a long process. We're not sure how long that will take. But as soon as the COFI bill is enacted, then the conduct of business will be regulated under this one act. And under this act, there will be different conduct standards, or perhaps in some cases joint standards between us and the Prudential Authority that will sit underneath this primary legislation that is the COFI bill. So you'll see on the slide as well, this really underpins also the shift from a more outcome and principle-based legislation and regulations. So some of the financial sector laws still have a lot of specific rules instead of being more outcomes and principle-based. We have changed a lot of the legislation, especially on the insurance side. There's a lot of principle-based type of requirements in the TCF requirements, for instance. And this will move this even more to a principle-based framework. Okay, so this slide just gives you an idea. We won't go into detail on this, but you'll see how it's envisaged. It still can change through the parliamentary process, but how it's envisaged at the moment is that it will be activity-based license framework, as opposed to the previous institution-based approach. So currently, you are licensed as an insurer, for instance, or you're licensed as a specific institution. But from a conduct side, and that's very important to understand, you still have the, for instance, with insurers, You still have your license with the Prudential Authority, but you will also have a license or licenses with the FSCA, depending on what activities you provide. So for instance, if you do advice, that will be a licensed activity under the Conduct of Financial Institutions Act, and you will need to have a license for advice. If you also do distribution, then you may need the license also for distribution. So you may have a couple of licenses with the FSCA, depending on what activities you do, that is regulated activities. So I've mentioned really outcomes and principle-based requirements. We want to make sure there's a consistent set of outcomes within the financial sector. So currently with the different pieces of legislation, it's really a fragmented approach. Some of the pieces of legislation will have a requirement in that is very similar to a requirement in another piece of legislation, but it's not quite the same level of protection that it gives. And we want to make sure that there's a consistency between all the different sectors in the financial sector, that there's the same level of protection to all the customers, regardless of what type of financial institution you are dealing with. So there's also a specific focus on transformation, financial inclusion as well, innovation and competition within the COFI bill. So unfortunately, there isn't a recent version of the bill available publicly. So as soon as it goes into Parliament, then you will be able to see the latest version. So there is a version, but it's a couple of years back that you can find on the internet, but there has been a lot of changes since that version. So this slide shows you what is the future conduct sectoral law architecture. You'll have your primary legislation, is the COFI Act, there in the middle. Then you have your conduct standards that I spoke about. So that's conduct standards that's been issued under the COFI bill, and it will follow a themed framework. So for instance, your governance and culture is one of the themes, and you will have a standard, a conduct standard that is issued that specifically speaks to governance and culture, for instance. Your fit and proper requirements, that's now sitting within the FASE Act, that will be a separate standard that only speaks about fit and proper requirements that's applicable to all financial institutions. And the same you'll have for some of the other themes like cybersecurity and cyber resilience. There's already a joint standard that's published on that, and that's one of the themed standards that sits under the COFI bill. And then you'll also have other things like guidance notices, that's non-binding, that can be issued by the FSCA, and other legal notices, and also interpretational rulings, where there is uncertainty, and we can see that the industry have uncertainty about the interpretation of a specific requirement. We can always do an interpretational ruling to give clarity to that aspect. So I'm just going to pause here for a moment. There is really a lot of detail that we're going to go into when we go into the current insurance regulatory framework and into some of the rules. So I'll just pause here. Is there any questions on the Twin Peaks model and the COFI bill that you have uncertainty with? I can't see hands. Let me just open and see if I can see any hands. Okay. If there's silence, I'm going to accept that you understand the architecture and you're comfortable with the two separate entities and what their objectives and functions are, and where we're going with the future regulatory framework. So I know there's a lot to take in on the future regulatory framework, but it will be a process that's a staggered process. It wouldn't be immediate implementation, but what I do suggest is when the version of the bill goes to Parliament, it becomes public, please have a look at it, just familiarize yourself with how that future framework is going to look like, because it will definitely impact the you working in the industry. Okay, then I'm going to go on. Let's look at some of the stakeholders. So before we go into the detail on the framework, we're just going to pause quickly and look at some of the stakeholders in the industry. So previously you had, before the Financial Sector Regulation Act, you had the Ombudsman for long-term insurance, the Ombudsman for short-term insurance, and you also have the phase Ombudsman. That specifically look at financial services and complaints regarding financial services, advice and intermediary services that have been given to clients. And also then the pension funds adjudicator with a very specific focus on pension funds, obviously. So the FSRA established the Ombudsman Council. So the function of the Ombudsman Council is to mediate disputes. And the Ombudsman Council is required to oversee, the recognition and cooperation and promotion and public awareness of ombuds and ombudsman schemes thereunder. So the Ombud Council is also required to protect independence. I mean, that's a big part of the reason the Ombudsman Council was established, to have independence as well when it comes to complaints handling. Sorry, just give me a second here. Okay. So the Ombudsman Council has oversight powers on the different statutory ombudsman that have been created, and also the industry ombudsman. So all of those ombudsmans that I've mentioned and is on the screen falls under the Ombudsman Council. But additionally, there's also the Office of the Credit Ombud that you may be aware of, also the Ombud for Banking Services, and the Ombud for the Johannesburg Stock Exchange as well. So there's also a major change you see, not just from the fact that the regulators now split into two, and you have the Prudential Authority and the FSCA, but the Financial Sector Regulation Act also changed the system of the Ombudsman to bring and establish this Ombud Council that oversees all the different types of ombudsman. So now you have the NFOS, the National Financial Ombudsman Scheme. So I'm sure you are all familiar and have dealt with certain complaints under this new structure. So the National Financial Ombudsman Scheme commenced operations already in 1 March 2024. That's just the umbrella financial services ombudsman, and an amalgamation of the ombudsman schemes, the banking ombud, credit ombud, long and short-term insurance ombud. So still, the focus of this ombud is to resolve financial services complaints fairly, and also bring impartiality and efficiency within the system. So we are the regulator as the FSCA, but we don't necessarily look at individual complaints per se. I mean, what we look at is complaints that relate to an overall trend within the insurer, for instance. We do not have the same powers as the National Financial Ombudsman Scheme to give relief to customers on individual complaints. So we don't have the same focus, and that's why we provided the customers with this ombudsman schemes, so that their complaints can really be looked at and considered on an individual basis as well. So apart from the ombudsman schemes, there's also different industry associations, and they all exist with the purpose of promoting the interest of various industry participants. And from the FSCA side, what the industry associations bring to us is that it really facilitates discussions on a collective basis to get a feel for the industry view as well on something that we propose. For instance, if we are leaning towards a certain policy direction, issuing changes, for instance, in the policyholder protection rule, we engage with the industry associations collectively. And that's a much easier approach than to try and engage, obviously, on an individual basis with the different industry players. So obviously one of the industry associations that you are very familiar with is ASISA. So ASISA represents the collective interest of the country's asset managers, collective investment scheme management companies, also your linked investment service providers and multi-managers and life insurance companies. So ASISA's mission is really to ensure that the industry and its members remain relevant and sustainable by promoting a culture of savings and investment as well. And then you also get SAHIA. I'm sure most of you are familiar with SAHIA, so I won't go through all of these industry associations in detail, but I'll just mention a couple. So SAHIA, that's the South African Insurance Association. It's a representative body of the non-life insurance industry specifically. So it represents the industry to all relevant stakeholders to really ensure that there's a sustainable and dynamic industry. And they have a vision to promote and represent the interest of the non-life insurance industry specifically. So I'll just mention also the Financial Planning Institute. So the Financial Planning Institute's vision is one of professional financial planning. So that's their focus. So they want to provide professional financial planning to all customers, and they want also to ensure that there's a recognized professional body for financial planners in South Africa. So stepping away from the local industry associations, there's also other stakeholders that the FSCA deals with. So those are your international organizations. So on the screen, there's a couple of international bodies that are stipulated here, but there are really many more, but some of these are more specific to insurance as well, like the Insurance Association of Supervisors. One of the core things that came from the IAS is the core principles, insurance core principles, and that set the international standards for insurance legislative frameworks. So we consider those insurance core principles when we develop insurance legislation as well. You'll also see the International Organization for Pension Supervisors on there, IOPS. So IOPS is an independent standard setting body whose mission is to promote good practices in pension supervision and to serve as a worldwide forum for policy dialogue and exchange of information. So some of the examples of standard setting that IOPS did was the principles of private pension supervision and guidelines, and also good practices on pension supervision. So I won't go into detail on all of the different stakeholders on an international basis, but the one I'll mention last, I think that's quite important, is IOSCO as well. So that's the body that brings together the world's security regulators, and it's recognized as the global standard setter for security sector. All right, so I'm going to move on. We're just going to have a look at the prudential framework. So as you know, I'm from the FSCA, which is focused on market conduct, but our sister regulator, the Prudential Authority, we work very closely with the Prudential Authority. So there's a lot of matters that we deal with that do not have only a market conduct element to it, but also a prudential element, and then we have to work together on those matters. And we also bring out sometimes joint standards that provides for both prudential and also market conduct requirements. So the Insurance Act provides a consolidated framework from a prudential perspective. And that sets out consistency with the Constitution of South Africa and also international standards for regulation of insurance supervision. So under this Insurance Act, it replaced certain parts of the Long-Term Insurance Act and the Short-Term Insurance Act. So initially the prudential requirements was also within the Long and Short-Term Insurance Act. But with the commencement of the Insurance Act on 1 July 2018, that repealed some of these or all of the prudential elements from those frameworks and brought it into the Insurance Act. So now you'll see under the Long and the Short-Term Insurance Act, it's only relevant to conduct of business at the moment, and it doesn't have any prudential elements. So some of the things that the Insurance Act provide for is the licensing of insurers, micro-insurers and self-captives, and also certain functions are delegated to the FSCA in terms of the Insurance Act. So what's delegated to the FSCA is Section 5(1) of the Insurance Act. So no person may conduct business in the Republic unless that person is licensed under the Act. So unlicensed or unregistered business, that's delegated to the Financial Sector Conduct Authority. So both the supervision and regulation thereof has been delegated. So you'll see under the primary legislation, which is the Insurance Act, you also have prudential standards. Like we have your market conduct standards, they have prudential standards, for instance, the financial soundness standards, and there's also governance and operational standards. There's different prudential standards under the governance and operational standards. You'll see examples there on your right-hand side. For instance, the governance and operational standards for insurers, that's called GOI. There's several of those, and you also get governance and operational standards specifically for micro insurers, and that's also known as COM. So you can have a look if you have interest on that. So a lot of the terminology have been changed through the changes in the Insurance Act. Again, for those that have been long in the industry, we used to speak about long-term and short-term insurance. Mostly it's now life and non-life insurance. And when we speak about policy benefits in the old regimes, it's now about insurance obligations. And we'll just pause here for a moment because the insurance obligations is really central to understanding what is covered under the Insurance Act and what is considered to be insurance in South Africa. So you'll see the definition of insurance obligations is on the screen this morning. So it means all obligations, whether those obligations constitute an obligation to pay one or more sums of money, rendering service, or meet other obligations which arise under insurance policy. So that's the important part. So these obligations must be linked to an insurance contract between the policyholder and the insurer, and that can be in respect of life insurance policies. That's obviously on the life insurance side, and includes guarantees and discretionary participation features. So there's also a statutory definition of what is insurance business, and there's new definitions within the Insurance Act for policyholder group and individual policies. And if you look at the schedules in the Insurance Act, you have the classes and types of business that's set out. So for those of you that had a look in the Insurance Act schedules, I'm sure you all have seen those. Those specific classes and types of insurance business, the insurers need to underwrite their products with in the description of the classes and subclasses within Schedule 2 of the Insurance Act. So you have to report and underwrite your products within those descriptions. It must meet those specific descriptions. If you say that you offer funeral policies, you must look at that description within the Schedule 2 and what is the limit of what you can offer within that licensed class of business. So on these slides, it sets out just a bit of detail on the classes of business, that classification. So you'll see you have the classes, so risk class, for instance, with the subclasses, individual death, individual health, group disability, and those have the descriptions which the insurers need to meet. So relevant to you is obviously the classes of life insurance business that's on the screen. There's 9 of them. So that's the Insurance Act that regulates the prudential side of the insurance industry. We also have what's called SAM, your Solvency Assessment and Management Framework. So SAM is basically a risk-based regulatory framework for the prudential supervision of both insurers and also reinsurers in South Africa. So largely this framework is based on the Solvency II Directive in Europe, by the European Parliament and the Council of the European Union, and is primarily aimed at achieving heightened protection of policyholders in maintaining financial stability in the South African economy. So what SAM does is it establishes, I cannot say new anymore, but it established a new set of solvency capital requirements at that stage when it was introduced, with minimum capital requirements. There's also risk management, governance structures, and also reporting requirements within this framework. And you'll just see last mention on the SAM side, it really also considers proportionality. And I think that's a recurring theme within the insurance frameworks. As you'll see, as we publish conduct standards, or we publish joint standards, or the Prudential Authority publish prudential standards, there's always a flavor of proportionality. You don't want to overburden the industry with heavy requirements that is not appropriate or proportional to the type of business that they provide, but you also want to make sure that you mitigate the risks appropriately to consumers. Okay, so the next section, and I think we're going to spend quite a bit of time on this, is the insurance regulatory framework. So I just want to check, do you just want to take 5 or 10 minutes and get some coffee before we go into the detail of this framework? How are you all feeling? Okay, I see 1 thumbs up. For silence, I'm going to take as acceptance. Okay, there's a couple of more thumbs. Thank you for interacting. Okay, so it's 9:48. Let's just give it 10 o'clock. Let's be back at 10 o'clock. Then we'll spend some time. It's going to be quite a lot of information. But afterwards, we're just going to do some of the case studies, and I think you'll really enjoy that, and we'll interact a bit, and I'll get some of your thoughts and your views. So stay with me. Let's be back at 10 o'clock. Thank you. We're 10 o'clock. I take it everybody is back. I hope you got some coffee and you're ready for the next session. Okay, so we're going to go into the regulatory framework on the insurance side. So let me just share again my screen. All right, so we're going to start off with treating customers fairly. That's highly topical, I think, in your industry. Everybody knows treating customers fairly and what that means, hopefully, within the business. So treating customers fairly is not a standalone thing. It's something that has been embedded throughout the legislative framework when we speak insurance. More specifically, I'm sure you are aware of the policyholder protection rules and the rules regarding TCF, those 6 principles that have been embedded. So it's an outcome-based regulatory and supervisory approach, and it's really designed to ensure that your regulated financial institutions deliver specific and clearly set out fairness outcomes to financial customers. So what we expect from regulated entities is that they can demonstrate that they deliver the following 6 outcomes throughout the product life cycle. And I think that's an important point. It's just not just at certain elements when you deal with the customer, but really the whole product life cycle. From where you start off with the product design and promotion, through your advice and intermediation processes, servicing the customer, interacting with the customer, to the tail end of that product life cycle where you deal with complaints and claims handling. So that's what we expect. The 6 principles are on the screen, and I'm sure you're all familiar with this. It starts off with really ensuring that there's central fair treatment to customers when it comes to corporate culture. So not just an awareness, but really that TCF is embedded in the business. And that the tone from the top really goes through to the bottom and it resonates back to the top. So what's always great for me to see is that where an institution really lives TCF by providing avenues to employees where they can raise TCF issues, whether it be at complaints, whether it be at product design or claims handling, where you find yourself, do your institution provide you with avenues that's not just available, but effective, where you can go and say, look, I've dealt with this customer. I've picked up that there's really a TCF issue. If I look at a process or perhaps wording of the policy, this is my experience. Is there a possibility that we can relook this? And that gets taken seriously and goes to places where decision makers can actually affect changes. So that's great for me to see. I mean, that's true embedment, where it's not just about the visibility and the TCF talk and posters within your entity, but it's being lived through everyday experiences as well. So it's been a long process initially, to the TCF framework. It was developed since 2010. As I've mentioned to you, it's not a separate legal framework. It's embedded within the frameworks. Mostly relevant to you is the policyholder protection rules, but also obviously the regulations when it comes to different business dealings. And it's part of our mandate. I've spoken to you about the mandate a little bit on the earlier slides and the main focus on protecting customers. So that's where the TCF principles come in. So focus of today mainly is the framework and the market conduct side of the framework. So it's set out in the following way. We have your primary legislation, that is the long and the short term Insurance Act that focuses on insurance. And underneath these primary legislative acts, you have your regulations, long and the short-term side, and then also your Policyholder Protection Act. Policyholder protection rules, that's your subordinate legislation under these two acts. Then we also issued very specific requirements in the form of the conduct standard of third-party self-captive insurance business. So I don't know how many of you deal with this very specialized type of business, where you have basically an insurer with a lot of mini insurers within their system. They remain accountable, but they kind of, to easily explain it, rent out their license so that, these cell structures can provide insurance product without being licensed, but under the license of the cell captive insurance company. And then you also have your Phase Act. So the Phase Act, we'll speak about it a little bit in some of the next slides, but it's about advice and intermediary services. And under that piece of primary legislation, you have your General Code of Conduct, you have fit and proper requirements, and we also declared crypto assets as a financial product under the Phase Act. So I'm very passionate about fintech and crypto assets. So I worked a lot with this declaration and some of the work following this. So for those who are interested in fintech, I mean, it's worth having a look at the declaration and what we have published since then on crypto assets, as it's becoming more and more a part of the main financial system. We can see that there's a lot of uptake globally. So the market conduct framework, I've told you that the Insurance Act repealed the prudential aspects out of the Long-Term Insurance Act and also the Short-Term Insurance Act. Previously, the licensing, or we called it registration, was within the Long and the Short-Term Insurance Act, and it's now within the Insurance Act from the enactment of the Insurance Act in 2018. So what remains in the Long-Term Insurance Act and the Short-Term Insurance Act is really about the conduct of business for insurers, so market conduct focus. But the main requirements that you deal with on perhaps a daily basis is your regulations and the policyholder protection rules. So we'll focus the conversation further on the slides really about that. And we've spoken about COFI Bill. So what we have at the moment is an interim framework for insurance conduct pending this big change that's coming with the COFI Act and the future framework. So if we look at the Long-Term Insurance Act, as you go through the Long-Term Insurance Act, you'll see that following the enactment of the Insurance Act, the definitions that's used references the definition of, in the Insurance Act, because we want consistency of interpretation. Otherwise, you have this whole fragmented approach to your regulatory framework, where the prudential framework and the conduct framework have different definitions, describes things differently, and then it becomes a nightmare in terms of interpretation. So we wanted to make sure that there's the same meaning of the terms, regardless of whether you're speaking from a prudential perspective or where you speak from a conduct perspective. So just an example that's on the slide there, so I won't read it out, is a long-term policy. I mean, it cross-references life insurance policy. So whether you speak long-term policy, you speak life insurance policy, it's defined as the same thing with the same meaning across both your prudential and also your market conduct framework. There's some more definitions that you can see here. It's very important definitions. We have a life event. That's the life of a person having begun, continuing, having continued for a period. So that's a specific definition of a life event. We also define health event and disability event for those that work within policies that have components regarding to health and disability. And a death event means the end of the life of a person or an unborn life having ended. So that's some of the important definitions that you'll find within the Long-Term Insurance Act. And yes, I have explained to you that this is the market conduct framework, and underneath I've spoken about the policyholder protection rules, but you also have your regulations. So the regulation sets out things like commission. So you cannot get fees otherwise than regulated commission. It doesn't matter how many services you provide. Only commission is allowed up until certain maximums. That is also set out in those regulations. And it also says, when, for instance, commission can be paid. Some commission can only be paid after the acceptance of the first premium, or secondary commission only after the second premium. So this is all dealt with within the regulations itself. So it focuses really on the governance and business relationships between the insurers itself and its business partners. So you can see the regulations isn't focused on consumer facing, and that's where the policyholder protection rules come in. The regulations is really focused on the business relationships with insurers and business partners. So I'm just going to ask one question before I go on. You'll see on the screen there's binder regulations. Do any of you, and we can just take one maybe, work with, know what binders are and have work in a place where there are binder agreements in place? You have binder holders. Is that something you're familiar with? Okay, see, Marlene says no, Sonia as well. Oh, okay, that's very interesting. Okay, so there's specific binder regulations. That's within the regulations. And it's very interesting. It's really an outsourcing type of agreement, but it's very specific to certain activities. So what it means, just on an essence basis, is the insurer gives their pen to an outsourced partner and say, you can bind me into a contract without me knowing that I am bound, and you can inform me later on that you have entered into the contract. So, for instance, if a binder holder has an agreement to enter into policies on behalf of the insurer, then that binder holder can go to a customer, they can contract with that customer and sign the agreement. Now, the insurer has additional liability because there's a new customer on their books. They don't even know that. After the fact, the binder holder comes and say, look, we've written these policyholders. This is also now part of your liability. So it's a very important function because it increases the liability of the insurer without the insurer at that moment being aware of it. So if you get people that work on the systems of the insurer and the insurer knows in real time that these actions are taking place, that is not a binder because the insurer is aware of those activities as it happens. But if they only become aware after the contract has been entered into, for instance, that would be a binder agreement. So the different binder functions that you get enter into, vary, or renew a policy. You get a binder function about determining the wording of a policy. Then you also get determining the premium, the price of the policy, and then also the value of the benefits. And lastly, you get a binder for settling claims under the policy. So if you look at determining the wording, determining premiums as well, and determining the value, these are all underwriting functions. So obviously underwriting is about the process of insurers determining their risks. So binding is determining or varying or renewing the insurer's liability, and the insurers become aware only after the fact. So we have very strict requirements within the regulations when it comes to binding, and there's also specific provisions in regards to what are the fees that can be paid for these activities. So there's a limited amount of fees that can be paid. So you can pay up to a maximum of 9% of premium for these activities. So another big focus within the regulations is premium collection. So that's the authorization of and requirements of, for premium collection by intermediaries, again, third parties. So because the policyholders payment for these policies goes to a third party, we have strict requirements in respect of that activity. For instance, if a person pays premium to an intermediary, it's accepted that the insurer has received that payment. The insurer cannot say that, no, look, you've paid maybe to my intermediary, Jan, but I have not received it yet, so you're not on my books yet. That cannot work. Immediately, when you have authorized a third party to receive premium, if they have received premium, you have received premium as the insurer. And for those of you that works with contracts that's identified as health policies, so we have demarcation regulations as well. That's very specific types of contracts that is health-related policies, but it's not business of a medical scheme, but relates to, for instance, gap cover, or provides for income, certain type of payments when you are hospitalized. All right, we've spoken about this. Those are binder functions on behalf of the insurer. Okay, so look, the time the policyholder protection rules was enacted, there was a lot of thinking behind this, but post the enactment, we have made some changes to it. We've made significant enhancements to the version in 2004. I've told you about the IIS and the insurance core principles. So as those core principles developed, we considered those, and we also looked at identified conduct risks. So for instance, with the supervision teams, their experiences with the insurance industry and the problems that the customers are experiencing, that is fed into our process of thinking about the policyholder protection rules. So if we make changes, we also get input from our supervision teams and see where there's problems in the industry where the customers are not being treated fairly, and we try to incorporate principle-based requirements to address those problems. So the PPRs, if you look at all those requirements, the focus is on the insurer. Always the insurer remains responsible for compliance, whether you outsource. We've spoken about premium collection, we've spoken about binders. If you outsource those functions, you are still liable to the FSCA for compliance. And what we've changed in the PPRs post the first version is we've extended the scope of the policyholder protection rules to apply not just to policyholders, but potential policyholders, members of group schemes as well. And we've spoken about this TCF principles. It's embedded within the PPR. So especially if you read through the first part of the PPRs, we'll go through it starting from Rule 1. You'll see that those principles that we spoke of clearly comes out through those rules. So what are we trying to do with the policyholder protection rules? We're trying to make sure that there's fair outcomes to policyholders. In line with our mandate, we want to protect consumers from unfair practices by insurers. We know that insurers are profit-driven, but we do have to strike the balance to make sure that within that focus on profit, there is not unfair practices that leads to harm to the customers. So we also want to work to promote fair and transparent insurance that benefit both the insurers because they understand their business and they aim for profit, but also balance that with the policyholder, as I mentioned. Okay, so I'm just stopping for a second again, just checking if there's any questions. I know it's a lot of information. Sorry for the overload, but if there's any questions, if I can't see hands, just unmute your mic and talk to me. So you just give it 5 seconds to see if there's questions, and we'll go on. All right, fantastic. Okay, let's go on. Right, so we speak about new enhanced PPRs, but I'm speaking about the PPRs of the changes from 2004, the policyholder protection rules 2017. When I speak about enhanced PPRs, just before we go into this, we wanted to amend the policy protection rules a couple of years back again, and we were starting that process and starting to engage with stakeholders. But what we decided was to just put a hold on changing the policyholder protection rules again in light of the COFI bill. Because we know the COFI bill is imminent and will replace these financial sector laws, we decided to put a pause on those changes, and those changes will be incorporated under the themed conduct standards that I spoke to you about. So if we look at Rule 1, so amongst other things, it deals with insurers acting with due skill, care, and with policyholders and communicating clearly with the policyholder. What we want in terms of this rule is that the insurer have appropriate policies and procedures in place to achieve that fair treatment of customers that we spoke about. So the fair treatment of customers in terms of Rule 1 means that you achieve at least the outcomes that is outlined in the TCF outcomes. So where there's, for instance, advice, Rule 1 requires that the insurers must take reasonable steps to mitigate the risk of unsuitable advice. So they must think about this and make sure there's steps taken to prevent unsuitable advice. So if we look at Rule 1.2 to Rule 1.4, it really deals with the TCF requirements, and it includes, as I said to you, a member of a group scheme or a fund. And previously, why we included that within Rule 1 as well is that there wasn't protection afforded to underlying members. So the protection was limited to the policyholder. And in cases, in group schemes, you have these a large amount of members underlying, and the policyholder protection rules didn't provide any protection for those members that's actually the beneficiaries of the policy benefit. So we extended that towards members as well. So Rule 2 focuses on product design. So it requires the insurer to consider adequate information to understand the segment of the policyholders. So we want the insurer to consider its market in detail, understand really what segment are they serving, what are the nuances in those segments, what are the vulnerabilities. Let's say that you are targeting a very young population. Do you understand that that young population may not necessarily have the financial literacy and financial education experience? They're still young in the market. Are you designing products that's fit for this segment, that's understandable, speaks to that segment in a way that they can clearly understand the risks and also the benefits of this product? So that's what we want with Rule 2. So to this end, the insurer must make sure that the products developed target this segment. and takes in consideration the fair treatment. It also requires that senior management of the insurer must in writing approve products, and also not just the product, but the distribution channel. So again, looking at the market segment, is your distribution channel the correct distribution channel for the segment? So that's also very important. So rule 3 is very specific to credit life insurance. So there's two aspects that rule 3 deals with. So it deals with mandatory policies firstly, and ensuring that the cost of these mandatory policies comply with what is contained in the credit regulations. So the costs and those elements, it's not sitting within the PPRs, it sits within the credit regulations, but the PPRs do mention that it needs to be compliant with those regulations. So it also speaks to substitution of policies, and it requires that the insurer assist the policyholder or member in relation to a substitution of policy. So if there's an interest of the member or the policyholder to change their credit life policy, then the insurer must assist the member or the policyholder to comply with the demands of the credit provider as set out in the National Credit Act. So lastly on this slide, you'll see rule 4 that speaks to cooling off rights. So it deals with the right of the policyholder to cancel the agreement within 31 days of receiving the policy details. So this can really be used if you have not made a claim, obviously, on the policy as of yet. It cannot be used if there's already been claims on this policy. If the right is exercised, all premiums paid thus far must be refunded, but you can make certain deductions for the cost of the risk cover that was actually enjoyed by the policyholder at the point of cancellation. And also, when it comes to investment components, where there's a market loss or the market value of the investments went down, from the market conditions, then obviously there can be a deduction before there's a refund. So I'll try to go reasonably quick throughout the following rules, just to give you a little bit of idea what is contained in the rules. But we'll really stop a little bit at rule 17, so we speak about the claims rule and what that entails. Okay, so rule 5. You have a prohibition or negative option selection of a term and condition of a policy. So what this in essence mean is that an insurance policy may not stipulate that a specific term or condition will apply, except if a policyholder specifically elects a different term and condition. So that's not allowed. The only exception is if there's a specific term and condition that is required by legislation, then this is not prohibited. But otherwise, an insurer cannot do this. So if we look at determining premiums and excesses, so in essence, what it states is that the premium payable under a policy must be reasonably balanced between the interest of the policyholder and the insurer, and the benefit expectations of that policyholder. So it's really about balancing, not just focusing on profit, but looking at the consumer again with that lens. And it must also be based on realistic assumptions throughout the policy life cycle. So Rule 7 provide for, amongst other things, void provisions. So in the event of a dispute arising under a policy, the dispute can only, for instance, be resolved by arbitration. Let's say that is within the policy. That is immediately void. You cannot enforce that. you cannot say that the customer can only complain through an arbitration process because that's not fair to customers. It makes complex processes that's not always available. So that, for instance, would be void. Another term that is void is if the insurer says that, look, they're exempted from liability for omissions of their representatives or a person acting on behalf of the insurer. We spoke about this in some of the previous slides. The accountability always lies with the insurer, so you cannot put in such a type of provision. Then also in connection with claims, and I think that's very relevant to you, if there's a claim made under the policy, the policyholder or claimant may not be obliged to undergo a polygraph test, lie detector or verification test, or any other similar test or procedure that's furnished or made available by the insurer under the control of the insurer or such other person. So that's also something that is void. So Rule 8 speaks about waiver of rights. So no insurer or intermediary may request or induce in any manner a policyholder or potential policyholder or claimant to waive a right or benefit that is conferred on that person in terms of the policyholder protection rules. So if there's a right provided within the PPR rules, an insurer cannot say within the policy that, look, when you sign this agreement, you no longer have this right. That's not allowed. I think Rule 9 is a reasonably self-explanatory, signing of blank or incompleted forms. I mean, you all know that's a big risk to any policyholder. So what we say is that an insurer or intermediary may not permit or allow a policyholder to sign blank or uncompleted forms. There's really many dangers that lurk in this type of practice. So Rule 10 is a rule on specifically on advertising and marketing. So we make sure that there's proper processes and approval for advertisements in this rule. There's also sub-rules to ensure that if the insurer provides for the advertisement, that what is contained therein is factually correct and it's appropriately balanced and it identifies the insurer. And we state within that rule that senior management or a person with appropriate seniority must approve those type of advertisements and make sure that it complies with this rule. So the last one is disclosure. So just bear with me. I know it's a lot of rules to go through, but it sets out disclosures before entering into policy, specific disclosures after inception of a policy, and then also requirements on ongoing disclosure as well. So at the earliest reasonable opportunity after the inception of a policy, but no later than 31 days after such inception, you need to provide the policyholder with evidence of cover. Also the timing and manner in which the policy benefits will be payable or made available. And you also must provide comprehensive details regarding restriction or access to policy benefits, penalties, or early termination or withdrawal of policies, and also your charges and fees. So that all needs to be provided to the policyholder within that 31 days if it wasn't provided at the inception of the policy. And I spoke about ongoing disclosures, so it's really about disclosing information on any contractual changes during the duration of the policy. So if there are any changes, this needs to be communicated to the customer, and you must also provide relevant information to customers on an ongoing basis. So it's not specified what is considered relevant, because I've spoken to you about being principle-based in our requirements. So it depends on the specific policy and also on the specific target segment, what would be appropriate to communicate to the customer. So I'm just pausing here again. No questions yet. I'm happy if you fully understand and you're happy with the information provided, but I'll just pause if there's any questions. Okay, so last slide on rules, and then we'll do some case studies. So just hold on for me. Okay, so Rule 12, we spoke about in certain instances, insurers will ask third parties to perform certain function and activities. So Rule 12 really speaks about those arrangements with intermediaries and other persons. So insurers can only enter into intermediary agreements with independent intermediaries if they are licensed FSPs. So we had one of you mentioned FSPs when we start the introductions. So you have to be a licensed financial services provider under the Financial Advisory and Intermediary Services Act if the insurers enter into an intermediary agreement with you. So intermediary agreement must be entered into directly with the insurer and also provide the intermediary with the terms and conditions of that contract that's been entered into. So Rule 13, that sets out the requirements for an effective data management framework. You all know how important data is. Without appropriate data, the insurer doesn't know what is the liability of my book. They need to understand what are the risks, what are the type of policyholders that are on their books, how many products, what type of products, and also whether there's compliance with the requirements under the PPRs and under the regulations. So all of that needs to be informed by effective data management. So what is contained within this rule is that the insurer must have an effective data management framework, and it must include appropriate strategies, policies, systems, processes, and controls regarding the processing of data. And important, it also sets out minimum data requirements. So at minimum, an insurer must have the access to the names, identity numbers, contact details of all the policyholders. So I think that's quite straightforward, but you'll be amazed prior to the policyholder protection rules how big this issue was. That when the regulator went to an insurer and said, look, how many policyholders do you have on your books? Can you contact them? When did you last contact them? Many of the institutions did not have effective data management and really had updated contact details of some of their customers and perhaps didn't even have records of some of their customers. So imagine having to put in a claim and the insurer doesn't know about your policy. I mean, that was things that we saw, and this is the reason why we brought in this minimum requirements to make sure that there can be communication with the policyholders and that the insurers understand the liability on their books as well. So Rule 14 is about ongoing review of product performance. Yes, you've provided a policy to the customer, and maybe it was suitable at the beginning of entering into that contract, but you should also make sure that it continues to be relevant during the product life cycle with the customer. So in terms of Rule 14, the insurer must ensure that the product and its related disclosure documents remain consistent with the needs of those targeted policyholders and continue to deliver fair outcomes to the policyholders and its members, and also the distribution method of your communication remains appropriate. So again, and I hope you see that constant golden thread about understanding your customer segment, not just understanding your market, but specific segments to which you distribute specific products for. So Rule 15 is in terms of period of grace. That's in the short term, so we won't talk to this. And also then premium review in the long term. So a premium payable under policy can only be reviewed if the policy provides for a review and states the frequency at which and the circumstances in which this review will take place. So the customer must be aware in the policy document that a review of the premium can happen and what is the circumstances under which that can happen. The policy may, for instance, state that, look, we will review the premium once a year. If that is contained within the contract, that is what is allowed. You have to specify in that policy upfront when and if a premium review will take place. So Rule 16 is record keeping. So we spoke about data management and how important it is to have up-to-date data. And this Rule 16 also speaks to that in terms of record keeping. So it forces the insurer to have appropriate systems, processes, and procedure. They must ensure they can record all policy-related communications with a policyholder. There must be a record, must be demonstrated to the regulator when asked for, and they must have the ability to store and retrieve transaction documentation and all other documentation relating to the policyholder and the policy itself. And it must also be held in a way that's safe for this against destruction. So that's also an important part of that rule. So I'm not going to touch on the claims management yet. We'll just finish quickly. There's only 4 rules, and then we'll just focus a bit on claims management for a moment. So Rule 18 is a comprehensive rule. Complaints management, and those of you who deals with complaints will know this rule perhaps well. There's requirements for an extensive complaints management framework. Complaints is such a sensitive point in the product life cycle to a customer that it's very important, if we speak about treating customers fairly, that the customer is treated fairly when something goes wrong. So what we set out in this complaints management rule is that insurer must look at the nature and scale and complexity of their business and risks and have an appropriate framework in terms of complaints handling. What we want as a minimum for a complaints management framework is that you have performance standards and remuneration and reward strategies for complaints management. Why we have that in is we want to ensure objectivity and impartiality, so that the remuneration and performance standards for somebody that deals with complaints is not linked to, how many complaints you get, for instance. There must be a free flow of complaints to the insurer and easy access for the customer as well. There needs to be documented procedures that clearly defines escalation and review process and decision making, and there needs to be also a review process that's documented for complaints management. And again, record keeping, that's also a requirement that you'll find within the complaints management rule. So who is responsible for effective complaints management? Yes, you would have specific dedicated employees, but at the end of the day, the board of directors of the insurer, they are responsible for effective complaints management, and they need to oversee the effectiveness and the implementation of this framework. And what we also brought in with the PPRs that's quite important is a categorization of complaints. And in the PPRs, there's a listed of minimum categories. And why we brought that in again, again about the golden thread of understanding the customer. So you need to segment the complaints so that you understand where that complaints originate, not just in the product life cycle. Is the complaint about the product design? Is the complaint about premium review? For instance, you must understand those categories, but also the customer segments. So Rule 19 is just a replacement of life risk policies. So it deals really with where there's a replacement and the record of advice that the intermediary is required to provide to the policyholder in terms of the FASE Act and the General Code thereunder. And an insurer is required through senior management to be satisfied that the intermediary took reasonable steps to satisfy themselves that where there's a replacement of the policy, the replacement policy is more suitable to the policyholder needs than retaining the current policy. So I won't speak about Rule 20. Rule 21 is really about misrepresentation. So it's about material misrepresentation. What is material representation? So it's a non-disclosure shall be regarded as material if a reasonable, prudent person, so that's the test, a reasonable person test, would consider that the particular information constituting a representation or which was not disclosed is relevant to the risk of the insurer. So that's the test. Would a reasonable person see that this information that was not disclosed changes the risk of the insurer? So in other words, is it something that the insurer needs to assess its own risks? So that is what that really is about. So micro insurance products, I just want to ask before we go on, sorry. Is there anybody that specifically deals with micro insurance products? You can just thumbs up if you deal with micro insurance products. Yeah, okay, see nobody. Okay. So let me just explain it just quickly then. So micro insurance product standards, we have a definition of micro insurer. It's also a license category, but they're only licensed to deal with micro insurance business. So it's really about simplified products towards building financial inclusion. That's the focus. So the policies are limited to 100,000 plus inflation. And 300,000 when it comes to non-life insurance or life policies. So there's different rules that specifically are catered to protect the consumer in this segment that these type of policies are aimed for. So if we look at some of the rules, for instance, Rule 2A 6.1, that's restricted the waiting periods of micro insurers that they could set for death. So you'll see on the screen, a policy may not have a contract term of more than 12 months and must be automatically renewable at the end of the contract term. The value of policies may not exceed the amount prescribed by the PA, so I've mentioned those amounts to you. The policy may only provide risk policy benefits, so it's limited to that class of business as well. And the policies may not be subject to the principle of average. So there's definitions within the micro insurance framework, and that sits within the policyholder protection rules. We have a specific section there. You may not impose on a funeral micro insurance or funeral policy, you may not impose an exclusion for a pre-existing health condition other than through a waiting period. So it may not be excluded, but you can have a waiting period. And when it comes to suicide, both a micro insurance policy and a funeral policy cannot impose an exclusion for suicide for a period that exceeds 12 months from the inception date of that policy. So, so I spoke about the waiting period. So a waiting period may not exceed the shorter of 1/4 of the term of a policy or 6 months when it comes to microinsurance in respect of policy benefits payable on the happening of a death or disability event. And you cannot impose a waiting period on policy payable on the happening of death or disability event when it comes to an accident, so accidental death, and when a policy is renewed, you can also not impose a new waiting period, and where there's switching of insurance insurers on products, but the initial waiting period was already completed, then you cannot impose a new waiting period. We also specifically, if you deal with claims on the micro insurance side, then within 2 business days after the required claims have been received, you must assess, make a decision, and then authorize payment of the claim or repudiate the claim, whatever may be the case. And if a claim is disputed, you also have a time period that is imposed. There's 14 business days. You have to investigate further or make a decision whether or not it's valid to repudiate the claim. And very important from a claims perspective, protection that we brought in within the PPRs, specifically on micro insurance, is that you may not repudiate a claim on the basis that the policyholder did not disclose information unless the insurer specifically requested disclosure. So what must be disclosed must be very clear in that inception part of the policy. So I'm going to be brief on the Phase Act. I'm just going to give you a little bit of overview of the Phase Act. So as I stated previously, this is the primary legislation when it comes to advice and intermediary services. And you'll see, if you look at the definition of intermediary services in the Phase Act, it's very wide. It covers a lot of services, including administrative services. And from the advice component includes a recommendation, guidance, or proposal, if that is of a financial nature. And whether you provide advice to a client or a group of clients, that is covered within the Phase Act as well. And important to understand is when we speak about Phase Act, we're speaking about intermediaries here. So it's a conduit between a client and a product supplier. So for instance, in your case, it would be an insurer and a client. If you have a person that interpose themselves between the insurer and that client, that is what an intermediary is considered to be. So the aim of the Phase Act is really to protect consumers of financial products and services, and it regulates the selling and advice giving components of financial services providers. It also ensures that customers are really provided with adequate information about the financial products they use and about the people and institutions who sell these products. So both the physical collection of premium and accounting of premium is considered within the premium collection. Just to also say that when it comes to the Phase Act. So if we look at the Phase Act, you'll see on the screen there's a lot of different types of requirements that set out when it comes to financial services providers. So when you interpose yourself between the customer and the client, all of this becomes applicable. You have honesty and integrity requirements, you have competency requirements, operational ability to make sure that if you provide financial services, you have the ability from operations side, you have the systems in place, you have the people in place, operation that really fits the services that's being provided. There's also financial soundness requirements. So there's requirements in terms of financial soundness when you are an FSP and you provide advice and intermediary services. And there's also a heavier requirement from a financial soundness perspective if you also take premium from the customer. We have a lot of requirements within the Phase Act relating to conflict of interest, because what we want is that there's where you provide advice, there's independence when it comes to that advice, and that the advisor act honestly and fairly with due skill, care, and diligence, and always in the integrity of, with integrity and in the interest of the clients that they serve. That's really important. Let me just see if there's anything that I didn't say. Oh, yes, crypto assets. So we did say we regulate crypto assets also as a financial product. So that falls under the FASE Act from 12 October 2022. So over 300 institutions have been licensed as crypto asset service providers. That was the stats in December 2025. So those licenses are either existing FSPs that now also provide financial services in relation to crypto assets, or you have new FSPs that applied for licenses to provide advice and intermediary services on these type of products. So you can see there's quite a lot of activity in this place, and all of these phase requirements, unless they are specifically exempted, also applies to these FSPs in terms of crypto assets, and we call them CASPs, or crypto asset service providers. They have to comply with the FASE Act and the subordinate legislation as well. Okay, one more rule to go. Then we can quickly do case studies. So I'm just checking again, any questions so far? Are you happy with the information? Fantastic, thank you. Okay, let's do the claims rule, and then I'm going to just test your thinking and see what you think about our the two matters that I'm going to explain to you. Okay, so claims management rule. I spoke about the complaints management rule, rule 18. So 17 has a similar structure, and it's very, very comprehensive. So firstly, it speaks about establishment. You have to establish, maintain, and operate an appropriate and proportionate claims framework. Again, looking at your business and your complexity, it has to be appropriate. It also sets out, similar to the complaints rule, it sets out minimum requirements that a claims management framework must have. Again, documented procedure for dealing with complaints and also your escalation, your decision making. And it also provides for appropriate performance standards and remuneration and reward strategies. Same as the complaints rule. And again, why? It's to mitigate the conflict of interest and ensure objectivity and impartiality when it comes to claims management. Claims management is such an important component in the insurance product life cycle in the eyes of the customer, and it's really where the rubber hits the road in terms of treating customers fairly. So that's why we have this comprehensive rule in place. And it also provides that claims must be finalized within a reasonable time, and the decision needs to be communicated to the policyholder. And it sets out some of the practices that are prohibited. So if we look at the establishment of the claims framework, what we have is you have to have this adequate and effective claims management. It needs to be proportionate, as I've mentioned, and it has to enable claims to be assessed after taking reasonable steps to gather and investigate all relevant information and also appropriate information of the circumstances. And while you're doing this investigation, you have to have due regard for the fair treatment of the claimants. And it mustn't impose unreasonable barriers to the claimants at the claim stage. So it also speaks about allocation of responsibilities. The same as we had with the complaints management rule, the board of directors of the insurers are responsible for this claims management framework. They must approve it, they must oversee it again, and the effectiveness thereof, and make sure that it's implemented according to the policyholder protection rules. And it also states that any person that is responsible for making decisions or recommendations in respect of claims generally or a specific set of claims must be appropriately trained. So that's something that's set out in legislation. You must be experienced as a claim handler, you must be appropriately qualified, and you must not be subject to a conflict of interest. And important from my perspective, if we look at this rule, is you must be empowered, adequately empowered, to make impartial decisions and recommendations, or recommendations. So whether it's a decision or a recommendation, there needs to be empowerment of the claims staff to make those decisions on an impartial basis. So the outsourcing of claims, the rule says that if you outsource any claims process or any part thereof to an intermediary or binder holder, because we spoke about those binder functions, and the settling of claim can also be outsourced as a binding function, then it doesn't diminish in any way the insurer's responsibility. So I've mentioned that a couple of times. Accountability stays with the insurer. On the claims escalation and review, so the rule says that an insurer must establish and maintain an appropriate internal process in which claims can be escalated or reviewed, and where claims disputes can be resolved. We also put in record keeping again. That's a recurring theme within both the complaints and claims management rule. So insurers must ensure that there's an accurate, efficient, and secure recording of all the claims that have been received. So irrespective of whether the claims are valid or not, there needs to be a record of that. And the following must be recorded in respect of each claim. So you have to have all relevant details of the claimant and the subject matter of the claim. You have to have copies of relevant evidence, correspondence with the claimant, and decisions that have been taken on the claim. Also, progress and status of the claim, and whether that progress is within the set timelines or outside of the set timelines of the insurer. And the insurer must also maintain claims data on an ongoing basis. For instance, the number and also the quantums of claims that have been received, the claims that have been paid, again, both the number and the quantum, and also the number and quantum of repudiated claims, and the reasons for this repudiation. So some of the claims practices, let me just go to that slide. Yeah, it's fine. Let me just speak to it. So some of the claims practices have been prohibited within the policyholder protection rules. So an insurer may not dissuade a claimant from obtaining the services of an attorney or an adjuster. They may also not deny a claim without performing a reasonable investigation. And you can also not deny a claim based solely on the outcome of a polygraph, a lie detector, or truthful verification test, or similar procedure. You'll see these procedures referred to in Rule 7.1 sub A. So that's an important one. It's not saying that you cannot use a polygraph or lie detector, but you cannot base your claim decline solely on that. So what are the insurer's responsibilities? So where the claimant is a member or a beneficiary, the insurer must, on receipt of a claim, either obtain the contact details of the claimant to enable all communication required by this rule to take place directly with the claimant, or obtain consent from the claimant that communications required by this rule may take place through the policyholder concerned. So that is in essence what is contained within the claim rule. So I've only touched on certain aspects here, but because your focus mostly, many of you are on the claims aspect, it's important to go take a read through that detailed claims rule. It will give you a lot of insight on what is the views and what is the requirements from a regulator's perspective. That is, as I said, it's really where the rubber hits the road when it comes to customer-facing interaction. Okay, so it's time for the two case studies. So I first want to hear, and please let's have a nice interaction on the studies itself. Do you all know about the momentum and half on Nathan Ghana's case a couple of years back? Is there anyone that
Yes.
have not heard of this? I'll be surprised.
The name people,
Oh, sorry?
the name people won't know that case.
Yes. But it's a very interesting case. It had such a lot of media and attention. I mean, if you looked at the social media stats during that time, it really topped the charts. Everybody in South Africa was aware of this case. A lot of people were upset about what happened initially. So I'll just give a brief background. So you see the widow there, the niece of Mr. Nathan Ganas. So he was tragically shot and killed during the hijacking. And as we know, in South Africa, we have a lot of violent crimes. And this was one of those cases. He had a policy with momentum, and he had life cover of 2.4 million rand. So there was two components to this life cover. The one component was an instant payout of 50,000, and the remainder is paid on finalization of the claims process. So Momentum initially looked at this case and said, no, they're declining that. If they look at the policy and they look at the advice that was given, Mr. Ganas did not disclose the fact that he had raised blood sugar levels. Not that we're not speaking about diabetes, we're speaking about just a precursor, the raised blood sugar levels. So there was a risk of diabetes. What Momentum said is that, look, if this was disclosed to them, and they knew that he had this precursor for diabetes, they would not have issued the policy. So they void the policy and they will not be paying the claim. At that point, they already made a 50,000 payment to Denise, the widow, and it was demanded back. Said, look, it was wrongly paid, please pay this back. What upset most people from a social media perspective is that people were saying, look, what does this have to do with the policy claim? He died of gunshot wounds. It has nothing to do with diabetes. How can an insurer, he's been paying premiums all his life, the widow is emotional, it's a terrible thing that happened to the family. How can you then go ahead and decline the case? So what happened at the end of the day? The matter went to the ombudsman. At that time, it was a long-term insurance ombudsman, and the ombudsman agreed with Momentum and said, look, it was a disclosure that wasn't made to the insurer. The insurer didn't have appetite for this type of risk. If they knew it, then they wouldn't have paid out. So at the end of the day, after a big issue in social media and a lot of people complaining about Momentum and cancelling the policies, Momentum did pay the claim. And also what happened is there was some changes of some of the policies that was issued later on. Some of the policies now made specific focus, two components, one for accidental death and violent crimes like this, and one for other type of claims that results in death. So my question to you is, what is your view? And there's not a right or wrong. If there's such a claim and there wasn't a disclosure like this, should an insurer pay? or should an insurer decline the claim? I just want you to think also about the DITCOT principle that I mentioned there. So it's really about that principle is about fairness, where there's disclosure of material information. So what it says is what the insurer can consider is instead of automatically cancelling the contract, they should accept the risk anyway, but adjust the contract terms to settle. So, for instance, say that, look, we would have accepted this risk, but we would have asked an increased premium of 30%. So we're going to deduct that from the claims payout, for instance. So let me have a couple of thoughts from you. What do you think? Is it fair to decline this claim? Although it's not that he died from diabetes, or would you, in your personal view, say no, pay the claim? That's a valid claim. Okay, let me have a couple of thoughts.
Johan?
Yes.
Mostly we were, as everyone else, because as insurers, we were also interested in this matter, and we were spectators. We do not have the full merit of the claim. However, having said that, when going through the Ombuds report to say the insurer did not have an appetite to carry the risk of diabetes, even if it's not diabetes, but previously there was high levels of blood glucose, whatever. And now you go back to also look at the merit of would have Mr. Ganas died, could it not have been shot? Because the direct cause of death, even if no matter how long he stayed in hospital, and there were complications or whatever, the fact is we should consider that there was an injury that that's well, the word I wanted to use, subjected, but it's not the word he is, that exposed him to those infections and whatever in hospital that subsequently led to his demise. So there's a two-way about it, but yes, looking at it after all this, but we do feel as insurers that yes, Momentum was only under pressure because of what is this reputation and all that to pay. However, they should have gone back, irrespective of the media, but always save, protect the name of the company. So that's my take on it.
No, thank you, Zombie. I appreciate it. So I'll also give my views, but I'll just see, is there one or two other participants this morning that want to share?
I'll share. I think they should have paid it, but I think I don't know if I can say the responsibility is on you, the person getting the insurance, or the insurer needs to make sure the wording makes sense in the things that we tick off. Because I think if you don't work in the industry, you're not thinking of things like, you don't know about loading, you don't know about, oh, okay, if you disclose this, we might either decline the cover or we might give it to you. Like, people aren't thinking premiums as in the way that the insurer is thinking premiums. So yeah, I think they should have paid it, but yeah, I think there's something about the wording there where it's easy to like go, I don't think this is important to disclose, Yeah.
Yes. No, absolutely. I think it's a very important point that you mentioned. And it again speaks also to the market segment. As you say, you have to put yourself in the shoes of the people that you're selling to. Yes, you may have a certain perspective. You're an experienced insurance person. You understand the dynamics. Do the customer understand that? The customer may think, look, I don't have diabetes. Why should I disclose it? And an insurance perspective, it may be completely different. It's very important for them to know, even if there's raised blood sugar levels, because they know that it's a precursor, and this person may get diabetes, let's say, in the next 5 years, and they would be on the policy and a risk to the insurer. So that understanding must be communicated to the customer as well in a way that they know what is the limits to what they should disclose and not disclose. Anyone else?
Wouldn't the Ombudsman have picked up on the fact that our policy wording was not sufficient?
Yeah, look, they considered the specific case and the merits, and they found that the insurer wouldn't have appetite if it was disclosed, and it's something that should have been disclosed. It was relevant to the insurer's risk, but I think a lot of the thinking have maybe evolved a bit after that case because it really brought this to the forefront. So the Ombudsman, they do also have jurisdiction in terms of equity, so they can look at equitable outcomes. So they can look at something outside of the policy terms and conditions and look at fairness and whether it was a fair outcome. So I think on the merits of the case from a strict legal interpretation, momentum was not necessarily wrong, but that's why we are focusing on principles and outcomes to go a bit broader. And we want everybody working with insurance to have that mindset because you get, and I'm generalizing, but you get a lot of lawyers that work in insurance that struggle to change the mindset and they would be very strict in interpretation. But if you're in insurance, you have to have also that hat of the customer. Okay, someone else though, otherwise we'll go on to the second case study. Okay, so we'll go on to the second case study. The purpose really of the case study is just to get you thinking about different aspects to a claim, not just straightforward in terms of what are the rules set by the insurer and what does the legislation prescribe, but just a bit broader about customer outcomes and different components that may be present that isn't always easy to see just from looking at the claim at the first instance. So the second part is so there was a funeral. It's about funeral policies and insurable interest. This was this. Sorry, I lost that one. Just give me a second. Okay, let me give you another interesting case. I think that's going to be more interesting to you. Okay, so there was a lady, an elderly lady. She went to a branch of an insurer. It's a rural area. She stays in a rural area. She goes to the branch of the insurer. She goes to deposit 50,000 Rand into an investment policy. And the lady at the branch says to her, okay, here's the policy terms and conditions. Let me write you the bank account details. And you must go and deposit this 50,000. And she writes it down, and the lady takes it, and she goes and deposits 50,000 into that account. When she wanted to withdraw, she went back to the branch and said, look, I've deposited this 50,000 at this stage, and I now want to withdraw it. So the insurer said that, look, we don't have records of this deposit. The person that sold you this policy passed away, but you paid it into their personal account. You didn't pay it into the insurer. We're not going to be liable for that. If we do accept liability, we feel that you should have properly checked the bank account. Why did you go and deposit and not confirmed with your bank that this is indeed this insurance company's bank account? So we'll accept liability on a proportion perhaps, and we'll say that you were 70% negligent. So you're not going to pay back 100%. We'll pay back 30% of your money because there may have been also some liability on our side. So what are your thoughts on this? So this is a case that did take place. So the regulators had a conversation with this insurer and the approach that they took on this. So what's your thoughts? And again, I want you to think about the circumstances, the customer, the segment. That's the purpose of the case study. Okay, let me have some thoughts, please.
I would go. I
Fantastic.
think what should have happened there, the company should take liability of what happened because the employee was employed by the company and the customer did not go to that person's house. He went to the branch of the company. So liability still stands with the company. The company should pay the clients, and after they can recover from their deceased employees' family. That's my take.
Thank you for that. Zondi, you want to come in?
No, my take was going to be the same to say, as much as the insurer, we are saying to you, it is a business of faith. Whatever you say, we're taking faith in what you're saying. And as the customer, yeah, I came into your branch. Yes. So I believe that you are responsible for the actions of your employee. So whatever the circumstances, whether the person demised is no longer working there, there should be footage or whatever evidence that I got this information from here. So it was a matter of saying, yeah, I've got faith in this company that you are reputable for the fact that I'm deciding to come and invest my 50,000 here. Yeah. So that's my take on it.
Okay, thank you. Thank you, Zondi. I see also on the chat, companies should take responsibility in this case. Yes, so look, in my view as well, and it's my own approach and view, is that, again, looking at the circumstances, and you've all rightly mentioned this, yes, you can look at it maybe slightly different if this person, the customer found this person on the street and accepted that yes, this person is from an insurance company, and they should have thought about it more clearly and made sure, look, is this person really from this insurance company? But if you go to a branch of an insurance company, you expect that this is legitimate. There's branding, there's infrastructure. A reasonable person would not investigate that more. And if that employee writes down a bank account number, a reasonable person will accept that this is definitely the account number of the insurance company. And going further beyond that, that speaks to distribution channels, the appropriate distribution channels, and so forth. So your distribution channel is an in-person distribution channel, and let's say your market segment, in this case, you focused on people in the rural areas, and some of them in that segment, elderly people. Now you have a person going into the branch, your distribution channel, which is appropriate for that segment. There should be more reliance then placed on that interaction from the insurance side, that the customer do not have to doubt that this is the insurer. So in this case, again, you had the situation of when it went to the legal department, that lawyer, and when the regulator spoke to that lawyer, the conversation was, look, but if you look at the laws of delict, if you go on a strict interpretation, there was a joint responsibility, and that's why there must be a proportionate. But that is not necessarily appropriate approach to take when it comes to insurance. You have to look further and look at whether that was a fair outcome in that specific circumstances. I see there's a comment. The company has an obligation to make sure that the advisors agents meet the fit and proper requirement, one of them being honesty. Absolutely. Agree 100%. So that was the second case study, just to get you thinking about all these different components. But thank you for taking your time listening to me. I know it's not always for everyone the most exciting thing to speak to legislation and go through all these specific rules, but it is very important. So I hope you learned something this morning, and you know where to go look if you want to go have a look on where the requirements are. If there's any questions, I'll just give a couple of seconds for anybody to ask me questions. If not, enjoy the rest of the course. I really appreciate your time. It was nice meeting everyone, and good luck with your careers in the insurance industry. Thank you so much.
Thank you so much, Joe.
Thank you.
Thank you.
Okay. Bye, everyone.
Bye, Joe.
Bye.
Bye.
Okay, I'm just calling Pumla back in.
Cool. Hi, everyone. I was a bit of a spy because I kept coming in and out, so I heard a little bit in between. So I think I'm not sure if you had a break, but let's take a break, and then if you could come back at what time is it? Is it 26 past 11? Yeah. Okay. Did he give you breaks in between?
He gave us a
One.
break at 9:50 to 10.
Oh, okay, good. All right. Well, let's I think come back at 11:45.
Thank you.
Okay.
Quarter
Thanks.
to 12. Okay. Hi, everyone. Okay, so I know that you've just had a session with regards to the FSCA. So as part of the learning, we sometimes combine MCQs with short questions. Sometimes you get short questions on their own, and like next week, you're going to have the MCQs on their own. So because we've got 45 minutes, I've just asked my Zola to upload a pop quiz type of question related to what you were doing today, as well as a little bit about the Ombudsman. So I'm going to project it here so that you can have a look at it. And if you can start with the outline, and then you'll also have time in the afternoon to just complete it. You do need to submit it today. It is individual work, so you can't work together on this one. But we'll structure it in such a way that you'll be able to have time during the session. So I'm going to upload it so that you can just read. I'm going to share my screen so you can read the questions for yourself. Start setting up the outline and then just start working on it in the 45 minutes that we have left. And then at 2 p.m., when you come back, you will be given some time to complete that. But I also need you to do something for me in the afternoon. So it's going to be a bit two-pronged. So there's 12 of you. So I will need to spend like one-on-one time with each of you to understand what your research project is about, because by now that should be cleared up in your mind in terms of what you want to do. So when you meet with me, I want you to tell me what you're planning to do and to just give me like a brief overview of why you chose whatever medical condition that you chose to me. That this part is not for marks, it's just for me to guide you if necessary with regards to the research. So you'll basically have to divide your time between those two things, doing the pop quiz that we're going to upload now, and then meeting with me for 5 minutes to just tell me what your thoughts are on the research and how far you are with that presentation. Any questions? Is that clear, guys? Yeah. Okay, cool. So if yeah.
This pop quiz, the marks contribute, like it's contributes to our overall.
Yeah, I think it's like 2.5%. But you'll see, you can do it in an hour, but you're gonna have about 2 hours because you'll have the afternoon to do it.
Okay.
Yeah.
If we're done, should we then upload it on the dashboard? Or do we send it to you?
No, don't send it to me. Have you uploaded anything yet?
No.
Not yet. Okay. So you need to upload it by 4. So I did that on purpose so that if you have any challenges, my Zola and is here. We're here to see how we can help you, just so that you can figure out how to load it. I've just literally sent it to her 5 minutes ago because our afternoon presenter, someone passed away in their family, so they're not able to come through. So I've just uploaded it for her. So just give her a few minutes, but then we will be here to kind of take you through it. And it's all about your morning session. So I mean, some of you might even do it sooner. If you finish it quicker, please then use the time to work on your research.
Okay,
so are we going to use a document to answer? Because I thought maybe it will be online.
Sorry, I didn't quite hear that.
All right. I'm saying that the quiz, are we going to use the Word document for answers? It's not going to be online.
No. You're going to use a Word document to answer, and then you will upload that Word document onto the grid.
Okay.
Okay, so
is Joe's presentation on the system already or on the dashboard?
No.
Can we use that? No.
No. but you'll remember from this morning.
Pumla, what's wrong with you?
And she keeps saying you will
Pumla.
remember, you'll remember.
You were here, Mos. You were asking lots of questions to Joe.
Ah, Pumla.
Joe shared a lot, Pumla.
Yeah, he did it. It's intense. Yeah, no, but I've got full faith in you guys. 100% faith.
The legal
This is
is
what
not
it.
our field.
Eh?
The legal aspect of stuff about the industry, it's not in our field.
So only Marlene will get 100%.
Yeah, only
here.
Marlene. So I think we should do a group.
So you know what we'll do? We'll take Marlene's marks and we'll divide them across the group. How about that?
Yeah, Marlene
Thank
take one
you.
for the team.
Thank you.
It's pass one, pass all.
Yes.
Ayala. I'm afraid all of us are going to fail then.
We have faith in you.
Ah,
gee,
Marine, we've got faith
thanks.
in you.
Yeah, just give it a bash. Let's see what it looks like.
Okay.
Preferably your own understanding. If you do put it through chats, I will take your stuff and put it in there just to see what the alignment is. So try rather to write it in your own words so that I can gauge your understanding of what you've learned this morning. Some of it you'll see does require you to go online and get an ombudsman report. And so just access that report and then just again interpret it in your own understanding. That's what we're looking for. Some of them are quite theoretical, so those ones it's fine. I actually am more wanting you to write it down so you can SWOT. So you can SWOT and then like some of it is actually in your head, some of the questions. And some of them are more applicable. So you will gauge and you'll see which type of questions require you to use examples from your own company. Like this is what I would suggest, and which ones not. Which ones are purely theoretical. Okay, so I'm just gonna share my screen. Okay, so it's 30 marks in total. So 25 marks will be allocated to the accuracy of your response, and then 5 marks will be just for like the layout. And so here's the first question. So the Financial Sector Regulation Act came into effect in July 2018, establishing the so-called Twin Peaks model of financial service regulation in South Africa. Regulatory bodies established in terms of this act include the Prudential Authority, Financial Sector Conduct Authority, and all of these provided no more than 6 sentences each, a brief description in 2 sentences of each of the function and objectives of each of these 4 regulatory bodies. Did that too many times. Okay. Got it?
Pumla, can you go back a little bit up to see mark allocation?
So this one is 8 marks. In total, it's 25 marks.
Oh, okay.
Yeah. Guys, I think it'll actually be more fun if you just answer it now. What do you guys think?
I think we should apply TCF to the class.
Treating customers fairly. So treating customers fairly, yeah. So what is that? Writing it out now.
Us not doing it now.
You know what I'm worried about now? That I give you this and that you work through your lunch to do it. That's what I'm worried about. That's why I want you to answer it now. Am I wrong?
Wait, you saying you're worried we'll work through our lunch break?
Yes.
Oh no.
I don't believe you. So answer it. Answer it now while I'm sitting here watching you.
Wait, but Pumla, it says all information can be found in course notes. The course notes are not online.
I know, but this is a pop quiz, guys. So just answer the question. It's fine. I will adjust it.
Answer it where?
On the
So
chat.
answer.
Function of each of its
Mm-hmm.
regulatory bodies.
I wish you could all put your cameras on so I could see your faces.
This question is for lawyers.
Okay, I'm doing a 5-minute timer. Answer the question.
Oh my
Hi,
goodness.
where
How are we answering the
Pumla,
question?
where do we answer? Are we
Just
talking to
pull out.
you?
No, pull out a Word document, like from Word, and answer the question in the best way that you can.
Oh, I must write my paragraph there.
Yeah.
On Word.
Write your paragraph in your own Word document. Now we're gonna do it live. I'm worried you guys are going to work at lunch. So open a Word document, answer this question. I'm gonna set a timer for 5 minutes. Okay, that's the end of 5 minutes. Can you guys still see the questions?
Still on it, almost done.
Yes.
Paula.
Okay, excellent. So excited that we're doing this together. Sonia, don't look so serious. You got it. Okay, I'll give you 1 more minute and then we'll move on to the next question.
Okay.
Okay, great. So then that minute is up for the first question. So if you guys could put your cameras on so that I can see you. We're gonna, I changed the format halfway through, as you guys noticed. So let's discuss. What did you get? Snotile, what is your response? Let's just learn together so that people don't work on this at lunch.
Am I supposed to give all 4?
Just give one, sis. Just give one.
The Financial Sector Conduct Authority, that basically speaks about TCF. That's what I wrote.
Say that again.
That basically speaks about client fairness, TCF.
Did you see the question again? So you did
Its
the
function.
conduct of you did the function of the conduct authority.
Yes.
So you did its function.
Yes.
And what is it? What are the objectives?
To ensure that the financial sector treats their customers fairly.
Okay. Did someone else get anything different? I'm not saying it's wrong. I'm just asking.
I can add.
Okay.
I can add. I said it also serves as a support for efficiency, honesty, and integrity of the financial service.
Okay. Sounds great.
Yeah. I'm adding on what Notile was saying.
Yes. No, I got it.
Okay.
And did anyone get to the Ombud Council? Can someone tell us about that?
Let me give it a shot.
Yay, go for it.
I said Ombud Council handles complaints from consumers. Objective is to make sure that complaints are resolved fairly in a way that it protects consumers' rights and within the law.
Yeah.
That's all.
Did anyone get anything different or want to add to that?
So they basically act as an independent body between the consumer and the insurer to make sure whatever the outcome is fair in respect of both parties at the end of the day, and it is a free avenue that they can pursue in order to try and get the outcome.
100%. Did Joe take you through any onboard reports? No. Okay. No worries. Okay, great. That wasn't too bad, hey? The Prudential Authority?
I'll go. I
Okay.
noted that it regulates banks, insurers to ensure safety and soundness. So it makes sure that institutions are licensed. It makes sure that there's compliance. It establishes standards that relate to operational risks, market risks, and it provides oversight.
Perfect. Did we go through everything?
The FST, the tribunal, is outstanding.
Okay.
The Prudential Authority also promotes the integrity of the financial service industry. That's part of their objective.
So, can anyone explain, like I'm a 10-year-old, like, is it together? Is it separate? Why is it structured in the way that it is? And what's the point? Like, how do these entities function together in terms of supporting a consumer like me? Just in like very simple terms.
I think for the consumer, it's there to make sure that you are protected.
And for the insurers?
That there's a standard way across the insurers of doing things to I guess to be fair on both the client and the insurer.
Yeah. And do
To
you guys
make sure they're
understand?
always doing the right thing.
Yeah.
And do you guys understand the different roles? Because this question was written by Lazan and Joe. Do you understand the different roles of these entities? Yes, no, maybe.
I think it
More or
overflows.
less,
It
yes.
seems like it overflows a lot, and the objectives mostly are actually the same, meaning the outcome is the same, what they want to try and achieve. And I think that is the one thing that makes it difficult to give a proper explanation of exactly what the difference is, because what they try to achieve are the same.
So then, just to play devil's advocate, is there like internal checks then? So do they internally check each other at any point if we're all going for the same outcome? Like, why have so many different entities doing the same thing?
There is a checklist, Pumla, because they are not the same. They differ there and there. It's just that it works as a relay, if I can put it like that. It's a relay. The FSCA check more into the efficiency, the honesty, the integrity, and then the prudent comes to promote the financial soundness and the security of the FSP. And then you have your ombudsman that act like a regulator, a regulatory body, something like that, if I can put it in my understanding, to be the mitigating factor between the insurer and the policyholder. And then we will have a tribunal where it's where the two parties are meeting together, to engage about what they are disputing about. That's how I'm understanding it.
Thank you. I like it when you put it in just like easy terms, just a way that is, if you even need to explain it to a client, that you're able to kind of use words that would resonate with them. Like yesterday, I was doing some statistic stuff and I put it to AI and I was like, just explain this to me. And it used like a pizza scenario or just an example, something that's just like tangible. So I don't have any of the answers to these questions. What I want you to do is to be able to understand them so that if someone asks you who is a consumer, you can explain it in a way that is easy for them to understand. The only way that you can do that is if you have the overall understanding of it, right? So that's why I'm asking you these questions so that you are able to relay it in a way that is accessible and is not using too much terminology. And I think while it's still fresh in your mind, you can definitely do that. Okay, let's move on to the next question. Okay, so I think you can do question 2 and question 3. Can you guys see it clearly? It's not cut off?
No, it's not.
Okay. Cool, so do question 2 and question 3. Remember to write it down somewhere, ne? Write your answers down somewhere. Sorry, guys. I see it says provided justification in no more than 24 sentences. No, it was supposed to be 2 to 4 sentences. Please don't write 24 sentences.
We weren't able to.
I don't want to read 24 sentences. Please give me a thumbs up if you're done with question 2 and 3. Just give people a bit more time. If you're done with 2 and 3, you can start looking at question 4. I think you can see it. If not, don't worry. Please continue with question 2 and 3.
Pumla, question 4 is a bit cut off. If you can maybe just move it a bit to the left. Yeah. Thank you.
Sure. Okay, guys, I just saw the time. Can you put your cameras on? Are you guys okay? It's not so bad, eh? Ne? Questions are not so bad now that you've seen them and worked through them.
They're not so bad, but they are difficult.
So
We are not okay.
So I
We'll
don't want you
push
to
through. We're gonna
yeah,
try.
I don't want you to worry about it during lunch.
That will be difficult knowing we're coming back to it.
Yes, you are coming back to it. But you'll have as much time as you need. You'll definitely be finished with it by 4.
Okay.
Yeah. That's when you need to submit it by. So when we come back at 2, I'm going to pull this is not okay. When we come back at 2, I'm going to pull you away from this for a few minutes so that I can gain insight on your research. Otherwise, you will have the afternoon to look through it as well and then just finish it up. Okay. All right, guys. I'll see you at 2. I still love you. Lots and lots and lots and lots and lots and lots and lots.
Doesn't feel like it today.
No,
Phumla.
today you don't. Today you don't. Today you don't. See you later.
Okay, bye.
Bye.
Bye.